Ken, first of all, before we go into the context of what they're going to do now in relation to previous decisions, what are we expecting from the MPC at this particular meeting?
Thank you, David. I think there are arguments for lowering the central bank rate and for keeping it fairly constant as well. I think if you look at the arguments for keeping the rate constant at 18%, the arguments run in three. I think the first thing that the guys are going to look at the Monetary Policy Committee is inflation. Whereas the trend for inflation has been for it to go down, currently stands at about 15.6% now. The rate has been going down due to base effects. If you actually look at what's going on the ground as represented by month-on-month inflation, that has been going up on a monthly basis. In fact, the latest number is that it was up by 1%. And that does reflect that on the ground, the cost of clothing, things like transport, rents, those are all going up. So life is actually getting more expensive on the ground and not cheaper as would be reflected in inflation. We've also seen that the core inflation number is something that the central bank is tracking fairly closely. And if you look at the last decision that they made, they were fairly unhappy with the trend line for core inflation, which actually appeared to be rising and not falling. I think secondly, the guys at the central bank are going to look at the forecast balance of payments position, and they're going to be looking at that in the context of the oil price having risen by 20% year to date. The Brent oil price has gone up. Oil does constitute obviously 25% of our import bill, and if the forecast balance of payments position is seen to be actually getting worse, then really they may choose to actually leave the rate unchanged. I know another thing that the guys are going to look at is a forecast for global economic growth, particularly Europe. The European region is actually headed for a recession this year, according to the IMF. I doubt that we are actually done with the crisis there. Obviously, Greece might leave, Portugal may need a second bailout, and a lot of the exports that we have into that particular region, whether it's tea, coffee, tourism, may take a bit of a hit. So I think the arguments for leaving the rate constant rather than actually lowering it may actually win this time around once again.
Ken, in South Africa, we always talk about the mandate of the Reserve Bank. On the one hand, it's to protect the value of the currency. It manages inflation. It keeps its eye on that. There's also a mandate for growth. How does the Kenyan MPC balance this? Is it under pressure to balance this? Is it an issue when they make their decisions?
It's definitely an issue. If you look at the mandate of the MPC, their mandate is stable inflation. They want to lower inflationary expectations and they want to keep the currency stable. I think if you look at what's happening now with lending rates being so high, they are now being seen to choke growth in the economy. It's very difficult to borrow at current rates. And I know that for them, obviously in terms of trying to balance out the growth equation, because that does feed through into the fiscal side, it does feed through into the central planning for the economy with regards to Vision 2030. There's going to be a need for them to want to try and communicate that they are actually interested in growth as well. And there's going to be a lot of pressure, as we have seen from various stakeholders, for them to begin to reduce or bring down the central bank rate, because that will act as the transmission or rather policy signal, especially to the financial services sector, to actually get lending rates down. I think as well, if you look at the currency now is fairly stable. It's not as volatile as it was before. And we've also seen that the central bank now is being very active in terms of mopping up any excess liquidity that we see in the financial system. They don't want this excess liquidity to show up in the currency like it did before. So obviously, I think those are some of the arguments that will be used to actually lower the central bank rate. But as I said before, off the backdrop of the first question, the responses that I gave, I know the guys are balanced on a knife edge right now.
Do the banks follow suit? Again, just to compare to South Africa, the MPC announces and the banks, the big ones, all immediately offer the same discounts or increases on the previous price. Does the same happen in Kenya? Are they freer to charge the rates that they want? Is there sufficient competition?
Interesting scenario in Kenya, because we saw banks begin to increase their lending rates last year ahead of the decision by the central bank to actually increase the central bank rate. So interesting scenario there. But we do feel that this time around, if you look at what's happening with the banking side, if you look at the increased competition that we are seeing, we've already begun to see some commercial banks begin to lower their lending rates, obviously in anticipation of the decision by the central bank to reduce the central bank rate. The central bank may not reduce the central bank rate in this meeting, but it is anticipated that by the time May or June rolls around, they will have to start cutting this rate because, as I mentioned earlier, balancing growth against what's going on in the economy right now becomes fairly complex. We've seen over the last 9 months, just to reiterate, central banks acting ahead of the central bank and actually lowering or raising rates in anticipation of what the bank will do. And I know for the central bank right now, they want to be seen in the driving seat. They want to be seen as the ones who are correctly analyzing, implementing, and transmitting monetary policy down to the rest of the financial services sector, and not really sort of playing catch up to what the commercial banks are doing.
And finally, Ken, 18% was the number that came on the screen, and to those of us accustomed to 7, 8, 9, 10, and then of course in the United States virtually 0, the effect of that on investors who need interest rates, how's that going to be affected by this decision, although they're still way higher than a lot of other places?
Well, I think you have to remember, David, that if you look at history, the central bank rate was launched at a rate of 6% and did stay at 6% for a fairly long time. So we are also fairly accustomed to low rates. In fact, the 18% that we see right now is fairly unbelievable, because if you look at the margins that banks are using to charge based on that, the numbers are simply astronomical. I think the consensus feeling in the market now is that 18% is simply too high a number, because that is being used to price a lot of financial products, a lot of financial transactions, and the prices of some of these products and transactions now are simply becoming fairly, too expensive, even so to speak. So there's every expectation, if you look at what we feel as Stanbic Investments as a fund manager, if you look at what our counterpart through Standard Bank is also saying, we all expect that, for example, the rate on the Treasury bill will be below 10% by the end of the year. We do expect that inflation will be in single digits by the end of the year. And I think that just points to the fact that a number like 18% in the high double digits is simply not sustainable for any part of the world, whether it's East Africa, Africa in general, or even on a global sort of basis. Those sort of numbers are fairly restrictive.